of the analysis, if you like. And let me turn on my whiteboard. Remember, if anybody has anything to say, just do so as I'm speaking. Highlights of the analysis. Let's start with the long cycle. Sentient Trader has identified an 18-month cycle in November of 2005, which is, of course, this trough over here. That's fairly obvious. It has identified the next 18-month cycle here in August of 2007, and that's it there. And that's the actual trough in price. Then the next 18-month cycle here in late October of 2008, and that's the trough in price, fairly obvious again. And then June 2010 over here. In fact, I will remember. It was. I cannot remember how many days. It was only a few days, or possibly a week after that trough in June of 2010, that Alain, who's with us today on the on Trader Chat, posted to the forum and said that the June trough was most probably a trough of the 18-month cycle. So that was an extraordinary call, which, of course, a year and a half later, we're still using, obviously, and it proved to be correct. Now, this analysis that I'm looking at here, and this is where we need to get serious about the analysis and start talking about it, is claiming that this trough here, which I believe was the 4th of October, was also a trough of the 18-month cycle. So I've marked it there. Okay, so there we have 1, 2, 3, 4, 5 troughs of the 18-month cycle. Sentient Trader does not have enough information with only 5 troughs of the 18-month cycle to position the 54-month cycle. But there is a possibility that the 54-month cycle should be positioned here in 2005, and then the next 54-month cycle here in June of 2010. That's very possible. It's something that we could debate. The other possibility is that it is not here. It should have, in fact, occurred on the previous 18-month trough, and that this trough here in October of 2008 is a trough of the 54-month, 4.5-year cycle. I expect some people will have opinions about that. So if you have any opinions about that, please let me know. But for the sake of today's argument, discussion, I'm not really going to bother too much about where the 54-month cycle is. Let's have I'm going to turn that off, and let's zoom in. In fact, of course, one of the easiest ways of looking at a phasing analysis, and I probably should have done that, is to plot the semicircles. There we have the semicircles, and we can see at a glance really easily, the 18-month cycles. There are the 18-month cycles. Remember, of course, the principle of variation specifies that cycle lengths are constantly varying, so they're not perfectly identical in length. Some cyclic theories require that cycles are absolutely exact in length, but it's one of the fundamental principles of Hurst cyclic theory that cycle lengths vary, so we don't require that. Okay, so let's have a look and see. I think that I certainly am completely convinced that the trough on the 6th of June, I believe it was, or 7th of June, was that a Monday? Monday, the 7th of June 2010 was the trough of the 18-month cycle. So what we're really looking at in the analysis that I'm discussing today is what's happened in the market since then. What I'm talking about first is my preferred analysis. This is what I think has happened. In other words, basically, I'm saying that I think that there was a trough of the 18-month cycle on Tuesday, the 4th of October, 2011. Now that comment, simply saying that, has far-reaching consequences, because the euro-US dollar informs a lot of markets. Nowadays, markets are really, really connected, and and I was talking to several people in Toronto about how markets are so interconnected. And one often uses an analysis of one market to inform an analysis on another market. And I'm speaking today about the euro to US dollar specifically because I believe the analysis is much clearer in the euro to US dollar analysis. The analysis of the S&P 500 and the Dow Jones Industrial, for instance, is open to a good deal of debate in terms of the importance of the trough, which also formed on the exact same date, the 4th of October of this year, in the American markets. Now that analysis is open to a good deal of debate, and I believe it's a less obvious analysis than the euro to US dollar. And I think that forming a concrete opinion about what has happened in the euro to US dollar answers many of the questions that people have about what's happening in the American markets. Not only the American markets nowadays, but of course global markets. Markets around the world tend to move with a great deal of commonality, which is another one of Hurst's principles. So having a look at the analysis of the euro to US dollar, I hope will inform not just what you think is happening in the euro to US dollar, but also what is potentially happening in many other markets around the world. So let's have a look at this analysis. The first thing I always do, having completed an analysis, is to have a look at what I feel is what's good about the analysis and what's bad about the analysis. The first thing that I tend to do is I change the chart from a daily chart to a weekly chart. If we're looking at this kind of a scale, as you can see, that makes it a lot more sort of clunky and obvious. And the first thing that I do, and this might be purely a personal thing that I tend to do, but the first thing I do is I look at the shapes of the cycles. I know I go on about the shapes of the cycles, and I give hour-long talks about the shapes of cycles, as some of you will know. But the shapes that the cycles make in the market is something that has fascinated me from when I very first started using Hurst's trading methodology. So let's have a look at the shapes that I see in this market. All right, and the shapes I'm going to be looking at in particular here are the shapes of the 40-week cycle, which of course I believe had a trough here in January of 2011. Of course, there was a synchronous trough in June of 2010, and the latest trough is the 4th of October this year. Let's have a look at those shapes. And this has to do with the sentient trading methodology we were speaking about last week, but let's not get complicated about it. I classify shapes according to the 5 legs or waves of a cycle move. So let's have a look at this first cycle from June 2010 until January 2011, and let's look at the shape that cycle made. Now, the first move up was, in fact, I'm going to draw this above price so that I don't obliterate all the price bars. The first leg was a nice move up. I'm drawing it above price. That's leg 1. Okay. Beautiful, good move up. The next next leg was a move down to the intermediate trough, which is, of course, the trough of the 20-week cycle. There's the trough of the 20-week cycle. That's leg 2. The next move or leg was a leg 3, which is the move up to the next peak. Okay. And then leg 4 or wave 4, sometimes I call it wave, or sometimes I call it leg. That's leg 4 is to the final trough. Now that I hope you can see is a beautifully shaped cycle shape. It's perfect, and I'm going to show you in a moment some very poorly shaped cycle shapes, and you can compare them. Between the different analyses, because I've got some alternative analyses to show you. Let's have a look at the next cycle shape from the first trough up to the first peak. I'm going to draw the cycle shape below the price. That's leg 1. Leg 2 is the move down to the intermediate trough, which is of course the trough of the 20-week cycle. There's the trough of the 20-week cycle. Leg 3 is not is not a very neat or very nice leg. One could interpret it as moving up to that point, or one could stretch leg 3 up to there. I favor the second position, so I would position it over there, and then leg 4 comes down to over here. Okay, and so there we have another cycle shape, not as elegant a cycle shape, but a very valid cycle shape. Now, why do I say that this is a valid cycle shape? I'd like to point out the relationship between the waves. Was it last week that we spoke about the sentient trading methodology? I believe it was. Not last week, I beg your pardon, 2 weeks ago in our last trader chat, I spoke about the sentient trading methodology, and I spoke about how the character of a market is revealed through either looking at a lot of statistics about that market or by looking at the trading of that market. Now, I don't want to waste time today, because I intended to keep today's trader chat fairly brief. I'm not going to waste time today by going through the artificially generated trading histories on the euro to US dollar. I'm just going to cut straight to the chase, and I'm going to tell you what tends to happen when you build trading histories in the euro to US dollar. And what tends to happen is that wave 1 proves to be a very profitable trade to make, okay, given the correct conditions of underlying trend. Wave 2 tends to be a very poor trade to make. You mostly lose money on it. Okay, look at those short wave 2s. So what I'm saying is that these wave 2s are in character with the euro to US dollar. The next thing you will note if you build trading histories from euro to US dollar is that wave 3 is actually a very dodgy wave to trade. It's not very reliable. Sometimes you get good trades, as you probably would have here, and sometimes you get very poor trades. So wave 3 is it's a characteristic of the euro to US dollar, that wave 3s tend to be unreliable. So this analysis gives us an unreliable wave 3. This wave here, if you were trying to trade this wave, I can tell you, you would have lost money somewhere down the line if you were trying to trade wave 3s at all. In fact, most of the sentient trading matrices that we build don't trade wave 3 at all, because it proves to be a very unreliable trade to make. So it's best simply not to trade wave 3s. And